So today's Cardinal Lesson, we're talking about a lifetime income annuity that has an additional long-term care benefit to it. So that's kind of a mouthful. We've shown you this thing before many times, and now today we're going to be focusing on the enhanced long-term care benefit that's on here. And I want to put it to Tom, and I want Tom to share with you like why we're doing this video today.
Yeah, I mean, we're doing this video because if you boil down all the concerns, all the worries people have when they come see us, really what it comes down to is the fear of running out of money. Is you are worried about spending too much or not having enough, and at some point in your life running out. What this annuity does is it really helps solve that problem. Is you have an income that's guaranteed for the rest of your life, if you're a couple for the rest of both of your lives, and it, again has this enhanced payout. So we'll get into the details in a second. Let me bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board, which we'll get to here in a second. And then we have the illustration that sort of backs up all the numbers on the board. We've highlighted some of the things we'll hit on the board there. Some of the numbers that are listed, you can go and find more details here. So if you are interested, go take a look at this. I will point out these numbers are specifically for a couple who are both 65 here in North Carolina. If you live in a different state, if you're different ages, if you're single versus married, these numbers will differ. So call us. We can run one for you based off your exact parameters, and we'll send it to you. So let me turn it back to Hans, and we'll get into more of the details that are on the board here.
Okay, so what we have is we have Mary and Joe, who are both 65. Joe turns 66 next month. Mary turns 66 in January upcoming. So that's important because of when they get the step up of the year. And I want to just take you to the chart and I want to show you the essence of it. They're putting $200,000. That can be IRA money. It can be money you have in savings in a brokerage account, not IRA money. Either one is acceptable. And what will be different between the two is how you pay taxes on this distribution that comes out, or whether there are taxes. And then October 2025 is when they're buying this thing. And then what they're going to do is let the money sit at the insurance company and grow for what in most of our financial plans, we're picking the time for the plan of when it's going to start, the income's going to start, a point in the future. But the client, you, do not need to pick that time. You've got a range of options. And what I would suggest is you don't take anything, you don't even consider it until January of 2027, which would be a year and 3 months from when they bought it. And then optimally, you would wait until January, or they would wait till January 2035, which is the end of the 10th year, beginning of the 11th year. And it just shows in this chart, what's the key in this thing is whatever their annual income is going to be, that once it starts, it keeps coming in till both of them are gone or both of them are deceased. So as an example, if Mary and Joe buy this thing, they put in the 200,000 now, and then they wait till the end of the 10th year. And the policy is going to then, the beginning of the 11th year, it's going to pay them $32,000 a year, or a little short of 3,000 a month, a lot short of 3,000 a month, about 2,600. And they start getting those checks. And as long as they remain healthy, both of them, they're going to come in at that level for the rest of both of their lives. Even if they don't remain healthy, the checks are going to come in. But there's an enhanced benefit that if either one of them needs long-term care services, then the 32,000 will double to 64,000. Okay, so it doubles, and then it can stay doubled for 5 years. So I've just spit out a mouthful, but let's look at some other examples. Let's say that Mary and Joe buy this thing with the intention of not starting it till the end of the 10th year, but along about when they're 70, they, which is out here in 2030, the end of the fifth year, they want to start the income. They just say, we're sick of waiting. So at 2030, they're going to have a $19,920, almost $20,000 a year that they can start that income. Going to be like 1,600 and change a month. And that's going to come in every month, again, until both of them are gone. So if one of them or both of them live into their 90s, this is going to be very good for them, starting with the fact that it doesn't matter what happened with the rest of their investments. They know they got that $1,600 check coming in, and that's going to come in until both of them are gone. Okay, and that's the essence of it. Is the longer you wait, the more you get, and then once you start taking the income doesn't stop until both of you are gone. And it has, a lot of people say, well, okay, this all looks great. It sounds great. And you're given the example where one of us lived to 97 and we get all this money. What happens if we're both in a car accident in the third year and we're both killed and we haven't never turned on any income? And so what your beneficiaries or your children, if they're your beneficiaries, are going to get is the death benefit. And the death benefit is nothing more than the cash accumulation value at that point. So your kids are going to get whatever's left in the policy minus any deductions. So and another example is somebody buys it, keeps it, pays the premium, and then they start this $32,000 income. And like 3 years after that, they're both lose their life. And um, so what their kids are going to get is, whatever the cash value is minus the money that they took out of the policy, and the net amount that's left in the policy is going to go to the kids. So just trying to give you an overall of the flexibility of this policy. Tom?
Yeah, I mean, I think like Hans mentioned, the sort of the fundamental idea of this is you put money here with the insurance company. They provide a known income that lasts the rest of both of your lives. I mean, that's really what it's designed to do. That income is not dependent upon the growth of the money, right? If let's say we go into a scenario, think of like 2008, for example, or something where the markets are really pulling back and stay depressed for a long time. Um, that does not affect this at all, right? Your income is guaranteed regardless of the performance. And then it pays out for the rest of both of your lives. If you're a couple or if you're a single person, it just pays out for the rest of your life. And then, like Hans mentioned, the death benefit is the remaining account balance upon your passing. Now, if you start this income and you live 20, 30 years collecting an income, pretty good chance there's no more death benefit left in this policy. But even when that account balance goes to zero, that income is still coming in. So that really is speaking to that fear of running out of money, right? If you think about what happens when you run out of money, if it's left in traditional investments, it's done, right? There's nothing left. You can't pull anything out of zero, and you just have to figure out something else to do. With this particular annuity and other annuities out there, is that income will continue. Even on a zero balance, they will continue paying that check for the rest of your life. And so that is really the crux of what we're doing here. The longer you wait to start the income, the higher it is. If you go back and look at the show notes and those charts, you start getting into the 11th, 12th, 13th year. The increase by waiting really isn't that much. So normally the longest we would recommend waiting on this particular policy is like in the 11th year. After the 10th year, go ahead and starting it. If you haven't started the income, go ahead and start it at that point. And then again, what's really nice about this and where we sort of started the video on is if we think about your biggest risks in retirement, running out of money, that's obviously a big one. Long-term care, right? That is a huge expense that you could face, that it will be a huge burden on your family. Having this ability to double that income to cover that need, I think is a really wonderful piece. It's not long-term care insurance, right? So it's an enhanced payout, but it certainly helps come in, cover that increased cost that you might be experiencing at that point to help preserve some of the other money you have outside of this. And with that, I think it's important to know that when we're recommending this, it needs to be built as part of a larger plan. Like we would never recommend someone take all of their money, put it here and have nothing else available, because there's some downsides to this, like liquidity being a main one, right? If we're getting a paycheck, that's nice, but if we need more than that, we need to have another pot to go pull it from. So it needs to be part of a larger plan. It needs to be part of a comprehensive, strategy. But this is very useful, very beneficial for you to create an income that you can't outlive.
Okay, so in my example that I was talking about earlier, Mary and Joe together started this income at almost $20,000 a year, which is about 10%, almost 10% of their original 200,000 that they put in there. So, and obviously that money has been able to grow for 5 years. And then at the end of the fifth year, they turn on this income, which factors out to 10% for life of both of you. So, and that's an uncertain number that they're going to pay out, because we don't know how long the oldest one of you, the second one of you to pass, we don't know when that is, but it takes away that uncertainty. But then we go along, and then Joe has a stroke, or maybe he had this right at 70, and they don't have long-term care insurance, or maybe they do, but it's not enough to pay all the bills. For whatever reason, or the extra money, this thing can immediately double as long as Joe meets the ADL requirement. So if Joe needs help with 2 of the 6 activities of daily living, bathing, dressing, transferring, we usually use bathing and dressing. With people that needing somebody to come help them, paid somebody to come help them, bathing and dressing are the simplest qualifiers, and most people need that. So he meets that criteria. Maybe he's getting the care at home. We're bringing in help. This income of almost $20,000 a year doubles to $40,000 a year, and it can stay doubled as long as Joe is alive and as long as he's still needing care, okay, for up to 5 years. So let's say Joe goes along, and maybe he lives the whole 5 years. And so maybe he uses up the doubler, and then at the end of the 5 years, what happens? Well, the income just goes back to the $20,000 a year, and it stays there as long as just one of them's alive. So then he passes away a few years later. Mary lives up into her 90s. She's collecting the 20 grand all along, but during the period of sickness, or up to 5 years, they collected an extra 20 grand a year. Now, what I want to point out is, let's say that Joe needs the doubler, but he only lasts a couple of years, and then he passes away. Well, when that happens, then Mary is the survivor. The income goes back to the 20,000 a year, and it stays there for the rest of Mary's life. And let's say Mary later needs care. As long as there's cash value in the policy, she can turn on the doubler again, and she could use it up to 3 more years, because the 5 years is between the 2 of them. Now, I'm not trying to bring up and show this as long-term care insurance, or even as a substitute for long-term care insurance, because there's many scenarios where there's a downside to this. And this doubler is not going to work. And plus, the amounts that we're showing here are not enough to pay the whole bill at an assisted living or for home health care. But this is certainly a help. I mean, we have many people that buy this for income purposes. When we're setting up the income part of their financial planning, and we got their Social Security check and another Social Security check, and then we can just put down for this couple, whatever point we pick, say it was at 70, we can put down another 1666 a month. And then we can know and put into our plan that they know they're going to have that 1666 for the rest of their lives. And as Tom pointed out, we're not putting all their money in here. I'm just using 200,000 as an example. So this is set up for the income portion, but then as an enhanced benefit is it's going to give them some extra long-term care insurance. Many people that are doing these financial plans with us, they buy long-term care insurance. And typically they don't buy enough to cover the whole bill in all situations. So we're going to be working a few things to cover it. We're going to work this, the long-term care insurance for the amount it pays, and then we might turn this on and immediately double it to get the extra money to go all toward the problem of long-term care. Tom?
Yeah, I mean, I think that we've hit on a lot of the points around that enhanced payout. One of the nice things about this particular policy is there is no underwriting, right? If we think of traditional long-term care or the hybrid long-term care policies we talk a lot about in our show, you have to go through underwriting. So if you have some serious health concerns, you might not be able to qualify for those. Something like this has no health questions. Anybody can purchase it. Like Hans mentioned, if we're doing it for long-term care, it's not as robust as what you can do when you're looking at just pure long-term care insurance, but it certainly is a nice benefit to be added to this. Primarily, we start with the income need, and then this added benefit is a really nice thing to include. But again, it needs to be part of a larger plan. Needs to make sense for you. And again, it's would never be with all of your resources doing something like this. But a very common example is we have someone coming in. They have Social Security. They maybe have delayed that, but Social Security is not enough to live off of, which is most people. And so what you'll do is you'll add something like this to increase their base level of income coming in from guaranteed sources. A lot of times we'll match their needed income to cover sort of bills and just sort of needed expenses, non-discretionary expenses. We cover that with these guaranteed sources: Social Security, pensions, annuities. Then we have the rest of the money invested for more long-term growth. And you, out of that long-term growth, is where you can spend some of your fun money, if you will, some of the travel, some of the gifting you're doing out of the growth assets, while our income is covered by our guaranteed sources. And again, that allows you to be a little bit less worried about the market fluctuations. We don't have to worry about some big downturn in the market because our income is covered from sources we know is going to come in. So again, everyone's situation is different. Call us. We'll walk through exactly your situation, see if this is right for you. It's not right for everybody, but a lot of people could really benefit from something like this.
Okay, the multiplier, the 2 times multiplier can be invoked is obviously you have to meet the ADL requirement, activities of daily living, and then the doubler or the 2 times benefit stops after 5 years or the accumulation value reaches zero. So let me give you a kind of a negative example where you can't completely rely on this. Let's say Mary and Joe buy this, they wait till 75 to start the thing. They wait till they're turning 76 and they started at 32,000. They immediately double it to 64,000. Excuse me, they don't immediately double it. They started at 32,000 and they collect on it and live happily ever after on their 32,000 of money, knowing it's going to guarantee for the rest of their lifetime. And neither one of them gets sick till their 90s. And then if they drain this account or they're pulling out these withdrawals at 32,000 a year and they've used up all the cash value, and then in their 90s all of a sudden one of them needs long-term care, and there's nothing left in the cash value. They're still getting checks, they're still going out, and they will keep going out till they die. They can't use the doubler because there's nothing left in the cash account. So that is a limitation on that if your account is down to zero, and then you're still going to get the regular check, you're just not going to get the doubled amount if it starts, after zero. The death benefit I already went over. It's equal to the accumulation value. And so there is a fee in this policy of 1.25% for all those benefits. I mean, it's just what the insurance company is doing is taking your money, they're holding it for a period of time, and they're guaranteeing right at the front end these numbers. And if one of you lives beyond the cash value, they're going to be sending checks out to you on a zero balance. That has a cost to it. So the insurance company is charging everybody that has the policy a fee that the ones that outlive that can do that. They're also, when you put the doubler in there, if people use the doubler, they're going to get to that 0 point of cash value even quicker. And that puts liability on the insurance company to pay the other spouse way into the 90s. So there's some risk on the insurance company's part. They're charging a fee, and this fee does not come out of the lifetime payments. It's only out of the cash value, and it's based on the original amount that you put in there. Tom?
Yeah, I mean, I think the fee is important to acknowledge, right? I mean, anything that has a fee, you need to make sure that you're getting value from the fee. A fee is only bad if there is no value that you're receiving for that cost. And so, again, what you're doing in this annuity is there is a fee, but what it's doing is paying for that income that's guaranteed for the rest of your life, which you wouldn't be able to do in traditional investments. And so, with everything, you need to look at the advantages and disadvantages of that. Certainly there's a cost there, but you're getting, from my perspective, you're getting a lot of value for that cost, something that's guaranteed to pay out on a zero balance, which again, traditional investments could not do. So again, you want to look at all sides of any decision you make sure it's the right for you, make sure it fits as part of a larger plan. And again, a lot of times something like this could make a lot of sense for you.
So this type of plan is great for people doing a financial plan with us. And we're going to take part of their money, put it into this, and we're going to increase their guaranteed income that's coming in for life. So it's just that simple. This thing works great, and it works well for singles as well. Um, and then, if we want to just talk about how this fits into comprehensive financial planning, we talked about your Social Security check a bit. We also talked about 401k, as most of the time when people are buying these, the money's coming out of the IRA. And something I didn't mention is you're able to buy this thing and then as a traditional IRA, and you're able to do partial Roth conversions so that over that accumulation period where you're just letting the money sit there, you can convert bits and pieces of this over to a Roth year by year by year so that when you actually end up getting the distributions, they're going to be tax free. So that's a nice benefit to put on there. We talked about income planning. We talked about estate planning to the extent that there's a death benefit, and we talked about taxes. So I'd like to bring Tom back on. I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.